This paper is about which investors matter for global equity valuations and expected returns. So the starting point for this paper is a large literature in empirical asset pricing that focuses on a couple of questions. The first set of questions is understanding whether it's discount rate variation or cash flow variation or both that explains variation and differences in valuation ratios across firms, both across time and in the cross-section. The second part of the literature studies the determinants of expected returns, again, in the cross-section and in the time series. Now, the typical approach to answering the first question is to use variance decompositions, where you use valuation ratios and potentially other predictors to forecast future returns and firm-level fundamentals. To answer the second question, what we typically do is we use factor models to explain variation in the cross-section and time series of expected returns. Now, this literature leaves a couple of unanswered questions. The first is, what information do investors attend to in the first place so that prices are informative about firm-level fundamentals? And the second is, how important are different types of investors for setting prices, and eventually in connecting characteristics to valuation ratios and as well as differences in expected returns across firms? That's where our paper comes in. Our paper is going to start with a simple theoretical model that's going to motivate an empirical strategy where we're going to be able to understand which investors are more or less important for understanding or for the cross-section of valuation ratios in firms and prices. So we start off with a simple model that motivates this empirical strategy. In the model, we're going to have heterogeneous investors. These investors predict future cash flows and assess the riskiness of these cash flows using a set of characteristics that's publicly observable, as well as potentially an unobservable set of characteristics. Now, investors' demand, as a result, is going to depend on the prices of assets, as well as the characteristics of these individual assets, and this latent demand of individual investors. If you clear markets, this results in a hedonic pricing model where the valuation ratios across firms are related to the characteristics, and the coefficients on these characteristics are related to the individual investor's demand. Now, motivated by this simple theoretical model that I'll give you some more details on, we're going to have an empirical strategy. Our empirical strategy has 3 steps. The first is to find a relevant set of characteristics that explains the cross-section of firm-level valuation ratios, as well as forecasts future firm-level fundamentals or profits. Once we've found a set of characteristics that we think represents a reasonable basis for explaining firm-level prices or valuation ratios, we're going to estimate an international asset demand system. We'll do this both in the US and the UK. And we do this using individual investor holdings data. Finally, once we've got demand curves for all of these different investors, we can estimate counterfactuals. These counterfactuals are designed specifically to understand which groups of investors are more or less important for prices being related to the cross-sectional differences in characteristics across firms. In particular, what we do is we compute counterfactual prices as if a particular group of investors, say hedge funds, mutual funds, or long-term investors, decides to follow a passive indexing strategy. I'll give you more detail on this later. So let me give you some details on our theoretical model. The model is going to be quite simple. It's going to have 2 periods, time 0 and time 1. There's going to be I investors. They're going to be able to invest in N different assets. Now, these investors are going to differ in their assets under management. In particular, they're going to have some initial assets denoted by AI0. Now, the investors care about payoffs in the second period, or time 1. They've got Cara normal preferences with some risk aversion gamma I. Now, we set this gamma I to be equal to some gamma divided by the assets under management of each of these investors. This allows us to have the tractability of a Cara normal model, but gives us similar implications to a typical CRA model. Now, what are the cash flows of the firms? The cash flows of the firms are some dividend paid out at time 1. That's D1 of N. And it's just going to be the book value of equity times the return on equity, denoted by rho of N of each of these firms. So assets evolves according to this equation at the bottom of this slide. Period 1 assets are going to be the initial assets, and then each of these investors are going to choose the number of shares that they invest in each of these firms. They're going to get some return based upon whatever the ROE is over and above the price. So we're just rewriting this here. Little q is the number of shares times the book value of equity, and MB is the market to book ratio of each of these firms. All right, how are investors going to differ? Investors are going to have different beliefs about the fundamental cash flows of each of these firms. So this row I is going to be the vector of ROEs or the vector of beliefs of ROEs of each of these investors. And they're going to differ in their expectations of the expected ROE of each of these firms, as well as the riskiness of the ROEs of each of these firms. And they're going to use a single factor model for ROEs. The single factor is denoted by F here. Now, how do each of these investors form their beliefs about the expected ROE, which is GI, and the riskiness or the loading on the risk factor, that's beta I? What they're going to do is they're going to use observable characteristics. Those are going to be in this variable x here, this vector x. And they're going to have different loadings on these observable characteristics for each of the possible investors. And there could potentially be some unobserved characteristics which show up in these values nu I for both the growth rates and the loadings on the riskiness. We're going to assume that investors agree to disagree and that they don't update their beliefs based upon observable prices. We do this for tractability. All right, so given these assumptions, the optimal demand for each of these investors, which will be this vector QI, is a function of a few things. It's going to be a function of the price or the market to book ratio of each of these firms, and it'll be a function of how they form their beliefs about the growth rates and the riskiness of the ROEs of each of these firms. Now, this demand curve at the top of this slide shows that we can use investor holdings data to see what characteristics investors use to form their beliefs about the actual firm performance. But we can't distinguish whether an investor holds more of an asset because they have a belief about the riskiness of the ROE or the growth rate of that ROE. They enter the same way in terms of characteristics there. The same can be said about this latent or unobserved characteristics. All right, now we can clear markets. Just add up all of investors' demand. And we can solve for valuation ratios of firms here. The market to book ratio of firm N is just going to be a function of the characteristics. You're going to have some loadings on the characteristics, as well as the latent demand of each of these investors. Now, this MI is going to be some weight here, and it's simply the AUM weight or the AUM share of each of these investors. And so what this expression shows us is that the cross-section of valuation ratios depends on the underlying demand and the way that each of these investors forms their belief based upon the characteristics. What you see is that larger investors or investors with more extreme views are more influential in driving the cross-section of valuation ratios across firms. All right, so motivated by this model, what I want to turn to now is our empirical implementation. What we want to do is we want to study which groups of investors are more influential in driving cross-sectional differences in valuation ratios and eventually expected returns across firms, and how both expected returns and valuation ratios relate to these characteristics. So our data comes from FactSet. We're going to use prices, fundamentals, and holdings from 2006 until 2016. We're going to look across 4 regions: Europe, Great Britain, Japan, and the US. That'll just be for prices and fundamentals. For the holdings data, in terms of coverage, we're only going to look at the UK and the US. We're going to focus on the top 90% of firms by market cap so that we focus on the large liquid firms that represent a lot of activity in the publicly traded sector. And then finally, we're going to classify each of these individual investors into 7 different types. We're going to have 6 types, which will be mutual funds, investment advisors, long-term investors, which makes up insurance companies and pension funds primarily, and sovereign wealth funds, as well as private banking, hedge funds, and brokers. Anything that we don't observe in the holdings data, we're going to attribute to the household sector so that market's clear and total holdings add up to the market cap of a given firm. This is just the largest investors in the US in 2016. All right, the first step in our empirical procedure is to find a set of characteristics that explains the cross-section of valuation ratios as well as forecast future firm profits. What are going to be our characteristics? Here they are. There's going to be 6 of them. We're going to use logbook equity, which is going to capture some size effect. And then our next 4 are going to be related to measures of productivity and profitability at the firm level. We'll use sales to book as a canonical measure of productivity, the Lerner index, which is just operating income to sales, foreign sales share, which is motivated by the trade literature, which suggests that only the most productive firms choose to export. And then as a measure of risk, we'll use market beta as a canonical measure of equity market risk. So the first thing I need to show you is that our characteristics do a good job at explaining the cross-section of valuation ratios. What we're going to do is we're going to regress log market to book ratios on our set of characteristics across each of these regions, as well as future 5-year ROEs on these same characteristics. The only thing that I'm plotting in this picture here is the R squared from those regressions. What you see is that in green, you've got the market-to-book ratios. In orange, you've got future profits. Across all of these 4 regions, you see that our characteristics basically explain the majority of cross-sectional variation and valuation ratios across firms. They also do a fairly good job of explaining future profits of firms. In the US, it's about 30%. The only outlier here seems to be Japan, which has a little bit less explanatory power. So our characteristics do a reasonably good job, or quite a good job, in terms of explaining cross-sectional differences in these market-to-book ratios. Now what we want to do is we want to understand which of these investor groups is more or less influential in driving cross-sectional variation and valuation ratios. So what we're going to do is we're going to estimate a tractable international asset demand system. We're going to have n assets. Each investor can allocate some AUM, similar to our model, in each period to assets. Now what we're going to do is we're going to allocate any assets outside the top 90% to an outside asset. All right, the portfolio weight of investor I in stock N in country C is going to have 2 components to it. It's going to have the allocation to a stock N conditional on investing in country C. That's the first component there. And then it's also going to have some allocation to country C. Let me show you these portfolio weights. Here's the allocation to a stock N once you've invested in country C. This is just going to be a logit, so portfolio weights are going to sum up to 1. What you're going to have is that the portfolio weights are a function of a few things. Prices, or market-to-book ratios, the characteristics which we have, and then latent demand, which is this epsilon here, which captures any variation in portfolio weights that isn't related to prices or our characteristics, that can't be observed by the econometrician. How are we going to think about the cross-country allocation? We're just going to have a nested logit specification for the cross-country allocation. This allows investors to substitute across assets in different countries when relative valuations change. And I'll show you some estimates of this cross-country substitution for different investor classes. All right, just rewriting each investor's, rewriting our estimation equation, you can see 2 challenges when we want to estimate the demand system. The first is that latent demand, this epsilon, and prices could potentially be correlated. This can happen in 2 potential cases. The first is if investors aren't atomistic. An investor might have high latent demand, which could also push up the price of this, or if demand shocks across investors are correlated. So we're going to need an instrument for price. I don't have time to talk about it here, but what we're going to do is we're going to exploit exogenous variation in investment mandates across investors following Koijen and Yogo 2019. The second thing that we're going to do in this paper is we're going to make a methodological contribution in terms of estimating these demand systems. When you have some investors, not necessarily small investors, but some investors hold very concentrated portfolios. This could be because they have very strong beliefs about the underlying assets. What we make here is a contribution that allows us to estimate the demand system for all investors, whether or not they hold very concentrated or few stocks. We implement a ridge shrinkage estimator to do this in the paper. What we do is we shrink the loadings on characteristics towards the market consensus. All right, let me show you some estimation results. Here's the estimation, grouping all of the investors into 7 categories here. These bars represent AUM weighted averages of the demand characteristics for each of these, or the demand coefficients for each of these investors. In the top left is the coefficient on price. This is just the loading on market-to-book ratio. What you see here is that a lower value of this implies a demand which is more responsive to price. What you see is that hedge funds and households have the most elastic demand curves with respect to price, whereas long-term investors tend to have the least elastic demand curve with respect to price. Now the remaining 5 panels are loadings on characteristics. And to interpret these, you have to know that these are deviations from the market consensus. The value-weighted average across these other 5 bars would average to 0. What you see here is that there's a lot of heterogeneity in demand for characteristics across these different types of institutions. You see in particular that hedge funds tend to lean against the demand for characteristics of other types of institutions. What about cross-country estimation? So this is plotting the coefficient which determines the elasticity of substitution across countries for different investor classes. A value of 0 here would mean that markets are perfectly segmented and investors just hold a fixed proportion of their portfolio in a given country. A value of 1 here would imply that cross-country substitution is just about the valuation of the individual assets and has nothing to do with the location of the country. What you see is that they range from about 0.1 to 0.3 here, implying that markets aren't perfectly segmented. All right. How are we going to estimate our counterfactual? Well, in general, all unconstrained investors are marginal in pricing assets. But it could be the case that some investors are more or less influential than others. How much a given investor matters for prices depends on, first, their size, second, how different their demand curve is from other investors, and third, how price-sensitive other investors are to changes in other groups of investors' demands. So what we do is we compute counterfactual asset prices as if a particular investor switches to strict market weights. This is equivalent to assigning the asset-weighted demand curve to that particular investor group. All right, here's the results for each of these counterfactuals. Each set of bars represents one counterfactual. On the left is for investment advisors. What we do is we plot first the ownership fraction of that group of institutions, and then in orange we plot the total repricing of the market. That is the fraction, the absolute change in the market cap for all of the firms in the market. What you see is that the largest change in prices happens when investment advisors become indexers. Part of this is mechanical. They have the largest amount of assets under management. What you see is that as you move to the right, the smaller investor groups change prices less if you were to counterfactually change them to holding an index portfolio. What's important to note here is that this is far from proportional. So you divide the fraction of market cap changed, or the total repricing of the market, by the ownership fraction. What you see is that for investment advisors and, say, long-term investors, the ratio is about 0.5, whereas on the other hand, for hedge funds, the ratio is about 1.5. So dollar for dollar, when you change hedge funds to pure indexers, they affect prices substantially more than, for example, long-term investors, which represent pension funds, insurance companies, et cetera. That's partially because these long-term investors are mostly holding index portfolios. What about the relation between prices and characteristics? I said that we ran regressions of log market-to-book ratios on characteristics. What we're going to do is we're going to rerun these valuation regressions in our counterfactual scenarios with these new prices and see how the relation between market-to-book ratios and characteristics changes in these counterfactual scenarios. So what I'm giving you here is just the change in the coefficient on the characteristic for market-to-book ratio for each of these counterfactual scenarios across columns here. We can focus on the coefficient on dividends to book here. All of the coefficients here are standardized. So when we change investment advisors to pure indexers, the relation between market-to-book ratio and dividends changes by 8.11% for a 1 standard deviation change in dividend to book. Now we can actually map this variation in the relation between prices and characteristics to the relation between characteristics and expected returns. We do this just by applying the present value identity. Market-to-book ratios are related to future expected growth rates as well as long-run expected returns. If we assume that in the counterfactual scenario that the relation between future profits and characteristics does not change, then we can directly take this coefficient of 8.11, use the persistence of aggregate expected returns, gives us about a scaling coefficient of 10 on this coefficient here. And we can say that in the counterfactual scenario where we change investment advisors to pure indexers, 1-year expected returns and their relation to characteristics will change by about 80 basis points. All right, so let me conclude here. What we've done is we've estimated an international asset demand system that allows us to understand which investors and which types of investors are more or less important for asset prices and long-run expected returns. A few of our key findings was that investment advisors have the largest impact on prices. This is primarily due to their size. But per dollar of AUM, hedge funds turn out to have the largest impact on prices, whereas long-term investors, insurance companies and pension funds, turn out to have the smallest impact on prices. Finally, you see that broker-dealers, because they hold a very small amount of assets, they turn out to hardly matter for this price formation process. Additionally, because they hold effectively an index portfolio. Now, our framework can be used in a lot of ways. The first is it can provide guidance to intermediary asset pricing theories. What we've done here is we've given estimates of the demand curves for all kinds of different types of institutions and shown how this aggregates up into overall aggregate prices. You can use these individual demand curves to understand each of these different groups of intermediaries. Additionally, you could use this framework to understand why certain characteristics, for example, environmental, social, and governance characteristics or risk variables, how those characteristics relate to valuations and expected returns, and which investors are driving the relation between those characteristics and valuation ratios.